Hey, it's Soleil in this episode 414 of the Orange Pill Investor. And today I want to talk about sabotaging my portfolio with this damn covered call ETF challenge. So I did the numbers um, yesterday after the market closed, and I was ahead of the covered call strategy ETFs by about 5 or 6 grand. Which really isn't saying much because since January 23rd, the covered call ETFs were only up about $1,000 from the starting position. I started them, I think it was $215,990 with just a MSTY position. And then at some point I added IMST along the way. Um, IMST had a kind of a disappointing dividend. It's like a 2-month dividend, and it was about the same as MSTY's single month dividend. But this MSTY one that they just announced is only like $1.47, and the stock was trading at 22 bucks, something like that at the time. So their dividend also dropped to about 7%. So from January 23rd to June 4th, the covered call ETF position was up about $1,000 in 5 months. Now my position was only up about 6 grand, which is like 2%, a little more than 2%. But I believe at the close yesterday, Strategy was trading at 373, something like that. And they were trading at 377. Oh, excuse me, no, 373 in January, and they closed at 377 yesterday. So just holding spot Strategy, you made $4 a share since January 23rd, which is like 1%, a little over 1%. And so I could frame this a bunch of different ways. I could say my 2% is double the returns of Strategy over 5 months, but it's still kind of pathetic because it's just been chop. It's just been kind of sideways, up and down, up and down. And then if you work in the tax implications, that 2% probably gets whittled away. Now it's going to be very interesting to see what happens when Strategy takes its next leg up, which we need Bitcoin to do something amazing first. And I think it's gonna be very interesting to see what happens with the covered call ETFs and with my strategy when Bitcoin hits 120, 125, kind of like the next leg up to 150. It'd be nice if it just goes be nice if we just go straight to 150. So November we had, we were up from basically 50, kind of creeped up to 70, and then we're like, bam, we went the other 35K. So like 50% from here. So it'd be kind of cool we already went up from 75 to 100. If we went up 50% from here, that would be kind of cool. But I'd be happy even just with 125. And when that happens, Strategy may make well, yeah, unless something seriously weird happens with the divergence of Bitcoin's price and Strategy's price. Strategy should make its next leg up as well. And I said last night on True North that Bitcoin just feels like a coiled spring right now. I'm not saying we can't see 80 again before we see 150, but we've just been kind of waiting since November. I guess we double topped as late as January. So do we got to wait another month or two for the spring to sprung? to springeth. I try not to make any kind of short-term predictions. However, my assumption is that the bull market is not over. It's just kind of getting started. So at least over semi-long term, 6 to 12 months, I'm kind of waiting for the next leg up. And it's going to be kind of cool to see what happens with the covered call ETFs and then my account that's trading against them. Since I only had like a $6,000 lead and I knew MSTY was going to pay a dividend on their holdings of about 100,000. And I thought, man, if they pay another 10% dividend, that's going to put them ahead of me again. And I'm just going to be like treading water. But I forgot the tendency of dividend stocks to shit the bed every time they pay a dividend, which is, I don't know if it's a defense mechanism or if the market makers do this or if it just kind of happens naturally. But most dividend stocks, and it looks like MSTY is not immune to it, because every once in a while somebody was like, oh, why don't you just buy the stock right before X dividend date? And a lot of people do, which is why the price goes up right before X dividend date. So they paid out, excuse me, X dividend, I believe, was on the 4th. And you can see that as soon as they announced the dividend of $1.50, the price shits the bed $1.50. Like, that's not a coincidence. So really, I guess I didn't have anything to worry about because they're going to pay the $1.47. I think I did this calculation already. So $1.47 times the 4,961 shares, they're going to probably pay me out 7,300. But the price of the stock dropped by $1.50. So it's almost like nothing happened. They didn't really catch up. And as a matter of fact, now I'm ahead like $13,000. So when they pay this 7, I'll just be back ahead 6 again. But it was a little bit annoying that the $1.47 divided by the $20 per share, I guess that's being gratuitous as well. I probably should have divided by the 22 before the price crapped out. But yeah, being generous, dividing the 147 by the, oh, I don't have the history. So dividing the 1.47 divided by the share price of, what was it, 2060, whatever. Yeah, they paid out like a 7% dividend, which has been kind of low. I think, yeah, IMST paid out a $7-ish dividend, and I think the stock was trading at 70. And then I think the stock, yeah, like immediately dropped to from 70 to 60-ish. Let's check the chart. Yeah. So again, IMST paid their dividend. It was trading somewhere between, I thought it was trading at 70. So $60 it closed here, and then boom, it dumped. Look at that, $7 a share from 60 to 52. And then it's just been kind of whatever, recovering or doing whatever it wants to do. So I guess I was worried about nothing, really, because I forgot that these dividend stocks like to basically, once they pay out that dividend, it just kind of makes sense that they're worth less. Like they have less assets under management. The point of the point of the strategy is for them to do that. So you can't necessarily hold that against them. People are doing this for income. But in this particular account, I'm also giving them the benefit of just reinvesting all of the dividends. So once IMST pays me, and I'm sorry, sorry, once MSTY pays me out, I'll probably buy well, I know it will automatically buy another, whatever, 7 grand worth of shares. So is that 700 divided by 2, 350? Maybe not 350 shares. That sound right? And then we'll see what happens next month. But I thought it might be a good idea to just take a look at their positions and see in real time. It's not the easiest thing to do in the world because you come here, this section, this is on yield max. You just go to the MSTY page and they're going to show you their top holdings, but you can't figure jack shit out from this, right? This only lists like, I think these are both long call positions. So you got to go to here, download all holdings. I downloaded the intra trades, but it was useless. So once you get that downloaded, it looks like this. I already hid all the treasuries, but let me hit the chats first, and then before I get started. What's up, Hermes? What's up, James? MS2 from Rex Shares just started trading. Okay. How about Strike, Stride, Strife Challenge? Yeah. I would definitely pick up Stride the next time strategy pumps to like 1,000 because that's going to be life-changing money again. And what I wish I had done, and this is something that Ben has mentioned a couple of times, is when you make life-changing money and your account is just like, holy shit, it just doubled or tripled or something crazy. It's too emotional to try to figure out what the hell's going on. And you don't necessarily have to take the whole entire account to cash, but if you take a significant profit, or like if you follow Grain's advice of, take 20% off the top, you don't necessarily have to let it sit in cash, but you can take 20% off the top and then buy like a Strife. Myself, I just buy the Stride because it's going to be cheaper and pay the same interest rate, and I'm not really worried about the risk. And where the heck is my head? Oh, it goes away when I do this. Okay, cool. Yeah, so the next time strategy hits like 1,000 a share or something, I may just take 20% off the top. My plan is actually to rebalance maybe 60-40, 40-60, 50-50 with Tesla. But if Tesla's already also already running, I may not want to buy into Tesla at highs. So I would definitely consider rolling some cash into Stride, STRD, and then just sitting there and just sitting on it for like a quarter. I can't remember what Ben said, how long you have to hold the dividends in order to get the better tax treatment. So I'll double check that and make sure that I really don't mind sitting in cash for that long. But it is a nice way of recalibrating your brain and just, like strategy went to 500 and then it hit resistance and it corrected back down to 250. So when we hit 1,000, does it make sense that it might correct back down to 500? Or if we hit 2,000, it might correct back down to 1,000. And when that happens, if I've taken a nice portion off of dry powder, basically stored as a preferred offering, it's possible, if you get lucky, could get a more favorable re-entry position. And then if the strategy just keeps running to 3,000 or 4,000 or whatever the hell it goes to, at least you're not sitting in cash. You're collecting some interest. and the preferred should get some appreciation. So it'd be like a little bit of a booby prize, I suppose. Hermes, all stocks drop by the dividend amount or more on the X date. Exactly. What's up, Joshy? Looks like we might have another choppy week until major economic events in 2 weeks, but we're looking great in this bull run. Still according to M2. Yeah. With the size of that bill, the big, beautiful bill. Mm, The marketing on this shit is just hilarious. Yeah, they got to print. What's up, Justin? Exchanging uppercuts for a while, but Nithy delivers the knockout punch. Let's fucking go. Hermes, yes, MSTY div will continue to decrease over time. This is by design. Yeah, and I'm almost tempted. I was almost kind of tempted to end the challenge because I'm like, I think I'm just dooming myself to underperforming. But yeah, it won't be the end of the world if I keep this up through the rest of the year. It'll be a fun little experiment. And by fun, I mean, yeah, underperforming and losing money. That's fine. All right, so I got these weeded out. We can get rid of cash too. And what you want to do is try to match up the puts and calls because they have synthetics. They create synthetics. And so if you look at this, a synthetic position is instead of holding shares, they're going to buy a call and sell a put. Same strike, same expiration date. So I'm just going to highlight these yellow. This is going to be like their base position that they're going to use to sell covered calls against. Let's see if I can find some more. And you'll know that they bought these calls instead of selling them because the value is positive. They sold the puts because the value is negative. So these calls, these calls, these calls, these calls, these calls, these calls, more and more. Okay, this ticker looks weird. MicroStrategy CLL option 400s. These got to be more calls. They use a lot of European options, but this one says US, so that's an interesting development. So it looks like all of these are US options, but the last time I watched their video, they intentionally used, which I assume these would be the European options, because in Europe you can't be assigned early. So they have no assignment risk whatsoever as long as they go ahead and just roll before expiration date on European options. And I haven't looked at these for a while, so these US options are surprising to me because they're putting themselves at risk for having them called away. Maybe they're only truly worried about their puts being assigned because then they would be forced to buy the shares, and they're actually, I don't know if it's not legally allowed, but it's either SEC rules or some kind of tax rules or something that prevents them from holding more than, I think it's 25% of any particular ticker. So these synthetics that they create is not, there's really no advantage to this. It's just how they get around the dumbass rules. So all of those are negative. So they got some more long calls here. But these 390s, we're gonna have to try to figure this out and drill down because from what I understand, they started adding some long call positions to try to get upside. So I don't know if this is one of their longs that they're trying to generate leverage profits with, or if these are more synthetics that they're using to sell more covered calls against. So I'm probably gonna have to, like, tally a bunch of these up and compare. I'm guessing, some of these you can just match up. So this is 40,100, 370 calls, and then they've got the same exact number of puts, and the strike is a penny apart. So it looks like they might be combining European puts with a US call, which doesn't really matter. It's just kind of annoying. I think I can make these yellow and still remember that they're, I think I make it a different shade of yellow. No, I don't have more than one shade of yellow. Make it like, there we go. So it looks like 40,000, like 49,000-ish, 48,000-ish synthetic positions so far. What am I going to do with these 66,390 puts? That's 620. So I don't see any other puts here. Oh, no, here we go. 390s. Okay, yep, exact numbers. Okay. So, and just so you know, like, I got good grades, but when they would give you that busy work and you had to do like crossword puzzles and find shit like that, I don't know, spatial type of things, I was like the last person to get done with my assignments. So for me, hunting and matching, the other game that my family likes to play, I think it's called Spot It. It's like a a speed game where you try to make matches. I always fucking lose that game. All right. Okay, so we got another one. These are also going to be long. Let me do another yellow. That's ugly as shit. All right, but it looks like these are all the synthetic positions. Let me just try to sum this up. Let's do and I think that's all of them. Yep. Synthetic. And let's just, so all of the rest of them are calls, positions, short calls, because they're all negative. So I don't see any of these speculative, kind of long call positions that I heard rumors existed. So shorts, let's sum up all the shorts. Okay, so that maybe that explains it. So they've got 122,015 longs, and they only have 11,000. I'm sorry, 112,426 shorts. And let's do equals. Okay, my bad. I just did a negative negative, so let's add them actually. Okay, so they're basically long 9,589 shares of strategy. I assumed they were just taking long call positions, but it sounds like they're just not covering all of their positions. They're covering a little over 90% of them, but leaving a little bit of upside here, which hasn't been working. And that's why the dividend was smaller. So, yeah, that makes sense. So, they've been paying out like 10%, but if they're only covering 90% of their position, it makes sense that their dividend would fall by about at least 10%. So instead of getting actually, and the dividend fell farther than that. You would think the dividend would still be able to function at 9%, but it's only 7. So I don't like what they're doing here at all. Um, it really doesn't seem like they're earning the 1% management fee with the way that this is being handled. I don't know how long these longs have been on. I guess that really doesn't matter. But let's just evaluate the short positions that they have. Do we have the dates for when they put these on? No. So I guess I would have to track. I'd have to like do this every single day, and that's not going to happen. All right. So they've got June 6th. Okay. So this is actually not terrible. I don't know how long they've had these on, but it's basically at the money. So these are very aggressive um, covered calls. And I don't mind any of these, honestly. I don't know if they do technical analysis and they have some way to predict, like, oh, we're not going to break out soon. Maybe, maybe not. But they should have been able to collect pretty decent premiums here at these prices. Excuse me, at these strikes and expiration dates. So I don't hate it really. I do this occasionally myself. I sold a couple of covered calls that were, one or two strikes out of the money on on last Friday, and then I rolled them out maybe Wednesday-ish. So these are very aggressive, but I don't mind it since they're short term. And then we've got another 11,000. So this accounts for like 90% of the portfolio. And then the remaining like 10% is 625. So I'm guessing they went out 30 days. It's probably been on here for a week or so. And they went out to the 400 and the 405. These are the ones I hate. I would not do this. Let's mark these in red for bad. Um, these are kind of like the ones that Michael Saylor mentioned. Like they back tested it, and if you sold at the money covered calls 30 days out, you'd end up with like 103% returns for the year. And that's absolutely true, but these are not optimal. And the reason is the theta decay curve that I showed during my options presentation at Strategy World was for 45 days to expiration, which 30 is close enough. It's fine to sell 30 days to expiration. Anything under 60 is probably fair game. Um, but according to Tasty Trades research, the sweet spot is 45 days to expiration with the qualifier for out of the money options. So, in honor of Hermes, who's on the call, that would absolutely apply to his favorites. So I'm just going to do the 36. That theta acceleration curve applies to the 10 deltas. approximately here-ish. Yeah. Um, I generally am a little bit more aggressive with it, but the point of the strikes really don't matter to me exactly. But the point is that for the out of the money options, the theta acceleration curve applies to anything out of the money. So it could be the 10 deltas, the 20 deltas, the 30 deltas, wherever you land on, it's going to apply to them as long as the stock trades sideways. If it trades up, then those out of the money options become at the money options, and then they become in the money options. But there's a completely different theta acceleration curve for weeklies, which is why I don't mind these at the money calls for weeklies. I'm going to make these green. These I don't mind. If you're going to be aggressive with it and you're a covered call ETF that wants to generate premiums and you want to sell at the money covered calls and just smash the premiums, I have no beef with that. Let's just go, okay, 8 days is like a little bit more than 1 week out, but bam, right? You're getting 2.5% return on capital for 8 days. You do that every week for 50 weeks, that's 100% returns for the year. You're forfeiting all of the upside, but that's what if that's the if that's the rules of the ETF and that's the rules you're going to trade by is you're just trying to generate the premium, then I got no problem with these. But let's just look at this. So there's, you can get $1,000 for 8 days, but let's add another week to this. It doesn't add another $1,000. You get diminishing returns. Now it's only adding another $400. Let's add another week, and we'll see those diminishing returns continue. It's adding another 400. So the weekly, you're going to get that big blast of like $800 or something for at the money. That's where you're going to get the full 2%. But you can see every week that we add on is only adding another like $400. And that's going to continue to diminish. Right now, for the fourth week that we added, it only went up a little under 400. And let's see, 2185 on the 375 strike. 21, actually, this one's up to 500. It could be the bid-ask spread. Yeah. So you have to be a little bit careful too, because the bid-ask spread is $2 wide here. So it's kind of showing you the mark price. But the bottom line is, every time you add a week, you're not adding the full amount of premium that you did in just a single week for these out of the monies. So that's why I wouldn't sell 30 to 45 days at the money. If I was just being super aggressive, I didn't care about any upside. I didn't care if my shares got called away, which I do. So I'm not recommending this. But the point is, if I was running this covered call ETF, I understand these for weekly, but I don't understand selling like at 380. The selling the 400 is like $20 out of the money. Let's just see what that is, what the delta is on the 400s. This is like barely better than a coin flip. Oh, 26 delta. Okay, so I was a little bit off there. So 26 delta. But see, the problem with these is you're already exposing yourself to increased gamma here. If you're going to hold these and it's already at 2 weeks, the theta acceleration curve has already sped up from 45 days to here. There's been a month of theta acceleration between here and now. And so now if you hold these 620s for 2 more weeks, now you're exposing yourself to all the gamma near expiration. So I guess technically these 400s and 405s are slightly out of the money enough to maybe be more affected by the out of the money theta curve. But unless they've had these positions on for a month already, they don't make sense. And me personally, I would be looking at something like this. Anywhere between, yeah, like 425 strikes. If I want to give more upside, maybe and collect less premium, I'm doing the 450. 10 deltas are probably, what do you say 10 deltas were? Probably 490, 500. Yeah. Anywhere between 425 and 500, I think is kind of the sweet spot at 45 days, depending on how much upside you want to bake in versus how greedy you want to be collecting premium. It's not really an exact science. The 10 deltas are going to give you more flexibility, obviously, because if the price runs to 550, it's going to be a hell of a lot easier to roll the 500 strike out out for a credit than it will be if you sell the 425 and it goes to 550. That's going to be rough. So, I mean, I hope that helps. It's not the easiest thing in the world, but that's when I've done this before, this is how I do it. You got to match up the same strikes for the puts and calls. That's going to tell you how many basically synthetic shares they've got. And then all of the ones that are left over that have negative market value, those are all the covered calls that they sold. And I would assume that their synthetic longs have done nothing. If we had run to 425 or 450 or something, then the 10, the 95, 89 shares, the synthetic, longs that they have created would have all printed. But whatever they saw in the chart hasn't happened yet. Now, if they continue to do this and we do get that leg up to 500, 650, whatever, yeah, these will work out. These will eventually print. So that's why I'm kind of like eagerly awaiting what kind of dividend they'll be able to pull out of the hat when Bitcoin and strategy make that next leg up, because this strategy has not worked over the last month, but it will. What's going to be also fun to watch is if we do chop for another month, will they get sick of these not printing? Especially if they have to give another uh, shitty dividend. And like 7% in 4 weeks is not shitty in TradFi world. It's amazing. But in Bitcoin world, we're used to what we're used to. So yeah, it'll be kind of cool to see if they make up for this. If we get a nice run and all of these longs that they don't have covered print. And maybe they'll be able to time it, like they'll capture the upside and then they'll add the other 9,000 covered calls at a higher price and collect more premium. Maybe IV will explode a good bit and they'll be able to generate better returns. But that's wishful thinking. So hopefully they'll get it together, and hopefully going through this exercise helps. Hermes Lex, that's a lot of nonsensical trading they do just to massively underperform strategy. They need to just sell 10 deltas on their synthetics. Yeah, They could hire you and just have, just pay one guy on their fucking trading team. Maybe they could reduce their management fee to 0.5% if they just hired you, Hermes. So, you got my recommendation. All right, Richard Parker, 66215 is matched right at oh, thanks. Yep, you caught me. Let's see. You'll be able to post your Strat World presentation on YouTube at some point. Yeah, I think we've been finalizing all of the things that were recorded. We also did like 40 interviews, so I was fortunate enough to get to interview Leon Vankman and Peter Dwan. I really wanted to interview Mr. Lee, but uh, our schedule kind of got bumfoggled and we had to reschedule him. So Tim got to interview him. Lucky bastard. All right. Let's see. Will you be able to post your? Oh, sorry. Yes. Yes, I will. And we actually ran out of a little bit of a time. We had a time crunch. We had a couple of unexpected things um, that was awesome, but it ate into our options time slot a little bit. And so I I had planned for like 20 minutes and I just fucking did a speed run and I was like, "Da-da-da-da-da." Okay, 7 minutes later, I was done. And I think we still finished like 2 minutes late. We had no time for questions. So we'll definitely post it, but then I don't want to like scoop that, but I'm gonna go ahead and do the entire thing live and and I won't omit anything. And I'll even try to spruce it up a little bit. Yeah, 10 deltas for the win. Yeah, it's kind of funny that they have an entire ass investment team and they're probably staring at charts and shit and they could probably just do better. They could probably just do better selling the fucking 10 deltas. Um yeah, that's all I got. I'm gonna keep going, you know, with the I'm gonna let this covered call account. This is in my IRA, so I don't mind the dividends getting paid out. This won't have any tax ramifications for me, but I am really looking forward to ditching this competition in like December so I can go back to trading my own money. It I didn't realize it was going to hurt my feelings this badly letting them paying them a management fee to underperform. It's kind of a hard pill to swallow. I'm probably not going to make any trades. I mean, MSTR is just doing whatever. It's not moving enough for me to have to roll any of these positions. And I don't have any cash to spend. I never really keep dry powder. So, you know what? I should take a look at Tesla though. Now I'm wishing I had sold. Isn't Tesla shit in the bed? I guess he's having his little fucking lovers quarrel with Trump, which is just hilarious to me. Um I think I replied to Elon's post with like a picture of Lucy pulling the football away from Charlie Brown because he just gets okey doked every time and he just falls for it every time. And Elon's probably one of the smartest people on the planet, but he's still too fucking stupid to not realize that you can't trust politicians. It's hilarious. Um, but yeah, so these are still in profit, but yeah, obviously my long calls here are taking it in the shorts, which is what did I? Let me just look at my activity in Tesla. The funny thing is I rolled my 310s. I bought them back and then I rolled them out to 390. No, I rolled them out. What did I roll them out to? Oh yeah, I rolled it out to the 400s. And what's Tesla trading at now? 300. So I always talk about not panic rolling, and fortunately I didn't panic roll. It was just the worst possible timing. So these damn things were like in the money by like $20 a share or something. And I had had them on for 2, 3 weeks. So it was time to roll anyway. But I could have just held on for a couple of more days and it probably would only cost me nothing. I probably would have been able to roll for a credit, which is hilarious. So actually, yeah, I guess I will be making a couple of trades today because now that the price is reversed again, it's already worth less than half of what I sold it for. So this is already ready to roll, even though I've only had it open for 2 days. Like it doesn't make sense to collect $1,000 in premium in 2 days and then hold it for another 43 days to collect the last 400. That doesn't make sense. So I will go ahead and roll these strikes down. And I'm just going to roll down to the expected move. Anywhere between like one standard deviation line and expected move, I think is pretty reasonable. Of course, if I was doing the 10 deltas, I'm pretty close to that already, so I could just leave these. I could just leave those there. All right, so that gives me a little bit of cash to play with. Not much. And is that just enough to buy? No, I can't buy another one of these long calls. But it's probably enough to buy another December. Where's my December 1080s? Yeah. Can I just buy another one? No. All right, cool. So rolled this down, collected some premium, reinvested the premium in strategy since I'm still pretty bullish on strategy for the rest of the year. But nothing else should need to really take any action here. Yeah, I think I'm good to go there. What's up, Kanal? It would be great to see the presentation on YouTube or wherever. Yeah, absolutely. I'm pretty sure it's all going to get published, but it's a lot of content, so I don't know if it's just going to be like a big bang and blast it all out, or if we're going to dribble it out over time so that we're not saturating. Oh, sorry, that's the IRA with the covered calls, ETFs. All right, here's my allowance. Wow. Okay, so this is interesting. So I just put on these put credit spreads, and every time that I would sell them and buy them back for half price and pocket the difference, I kept rolling the strikes up. And this is going to be a good test to see if this ends up working out or not, because I sold them around the expected move and it's already touching the strikes basically. So we're trading at 302 and the put credit spread's the 300 strike and the 290. So if this trades under 300, then I would start to lose money on this. You can see that I'm trying my limit order to buy this back is at 117, which means I collected 235 for this to begin with, and it's actually worth like double what I sold it for. So definitely going in the wrong direction. So at some point, I will either get a chance to roll this out for a break even, hopefully, or the price will reverse and it'll end up turning a profit. So we'll see. If I do end up losing the full amount on these, since it's a $10 wide spread and I got paid 235, my max loss is 765 on each of them, which is why I'm holding this little bit in cash here. Probably don't need to because they would probably just chalk it up to margin, but I'd rather not. All right, so I've got this one poor man's covered call. Nothing to really do there. It's only been open for 2 days. Yeah, nothing to do here. Move along. Nothing to see here. All right, here's the challenge account. Like I said, currently winning, but that could definitely change. And so the way that they're doing it is they're leaving 10% of their position uncovered, and the way that I'm doing it is buying long calls. So I stacked June's, those all expired 90% like losses. I was stacking July's, those all expired 90% losses. Then I started stacking the September's, and I was able to peel off some profits to buy shares with. And then yesterday, I sold a bunch more off. I think pretty close to break even, maybe I think the September's might have been in profit, but I think the December was slightly at a loss. But I really wanted to get up to this nice round number so that I could sell 6 covered calls instead of 5, which is the ultimate goal, is to just keep increasing shares and keep increasing the number of covered calls that I can sell. And you can see that I took my own advice here and sold at 45 days to expiration. And, this was probably somewhere between the 20 and 30 delta out of the money. The total delta on these longs only adds up to about, well, like 15. So if we get a sharp run up beyond this 450, this is not going to be enough. I don't think I would be able to avoid getting 100 shares called away here. This will mitigate it slightly, but I'm betting I probably need at least 20% of the covered delta uncovered in order to really make sure that no shares get called away. So in that case, that would be like 120 delta. So this is probably only adds up to about 10% of what I would really need. But I'm kind of in that transition period because I had to sell these positions to get me to 600. So that ended up being a little bit more important to me than making sure I don't get wrecked. And the plan will be to, as I roll these, This is actually I've only had them for 2 days, but since the price is down, it's almost ready to roll again. But yeah, as I generate profits here, I will continue to stack more. I'm probably done with September 1080s because there's only 16 days left that I would be even willing to hold these. So I'm already looking at stacking the Decembers. Haven't completely given up hope on the Septembers, but in 16 more days, I will exit those positions, win or lose, just to make sure that these don't fall prey to the theta acceleration curve that I described earlier. So it's December 1080 time, stacking time. All right, I'll take a quick look at the 5K account challenge. That's still holding up. Okay. Got some stuff expiring tomorrow. I'll probably be at, probably will have CLSK called away if it holds at $9. Yep. Same thing for Riot, trading at 916. So these will get called away. So then Monday morning, I may have a bunch of cash to decide what to do with. And just to keep up the strategy and keep up the demonstrations, maybe I'll just roll back into cash secured puts on both of these tickers. These 3 puts, I copy trade with my brother-in-law, so I'll do those offline. This 425 might be ready to roll. So there's 28 days left. I sold it for 19 and it's only worth 6. So yeah, this is ready to roll. But since this is a poor man's covered call, I have to be careful that I formulate it correctly. So the one that I'm selling it against is the 250 strike. If I add its value to that, then that means I should be at least selling like the 390 or above. So let's roll this out 2 weeks. To 43 days, as close as I can get to 45. And anything above probably the 400 strike is good. But do I want to be a little less aggressive with this? So if I roll out to 425 again, that'll give me 1,200 bucks. Yeah, let's do that. I don't want to be too greedy. So let's try to collect $6. That should give me $600 worth of buying power. And I don't think that's going to be enough to really spend on much of anything. I guess I could get a couple more September 1080s. But I did say the Decembers are too much, right? Oh, I could go to November, I suppose, if that's going to save me some money. Yeah, the December 1080s are a little too expensive for this account. Oh, God. And November only goes up to the 500 strike, so that's not going to cut it. October gives me a little more breathing room, but that's only up to 860. And I don't think I have enough, right? You only have 660 bucks. Yeah. I'll have cash on Monday when these shares get called away. So maybe I'll spend that money. I'll just leave 600 in cash for Monday. I think that's going to do it. Let's check the chats and call it a day. What's up, Andre? If you had $300,000 in strategy shares, could you make 150K a year selling covered calls without losing shares, do you think? Um, I was with you until you said without losing shares, because that is never a guaranteed proposition. But let's think about that. So at current prices, let's just call it 400 a share. With 300 grand, you could get 5. Wait, 100 shares is going to cost you 40 grand. 40, 80. Yeah. No, I'm sorry. That only gets you to 200. Like 700 and something shares. So you could sell 7 covered calls. So let's just say, selling the 425s. Um, that's going to be a little bit aggressive. You might end up losing shares here. Let's check the 10 delta specials. So the 500 strike. Just make sure I'm doing the math here. And actually, let's be a little bit more precise. So 300,000 divided by the current price of 372. Oh, you'd be able to get 800 shares. So 8 covered calls. 8 covered calls times 428. But that's a little bit misleading. So you're going to be able to collect $400, but every 2 to 3 weeks, you're probably going to roll it for half price. So this really only works out to about $100 a week. So that's times 100. You'd be making 800 a week times 52 weeks. So not at the 10 deltas. You could only come up with about this much. So let's reverse engineer it. 150K divided by 52 weeks. You need to make 2844 a week. Is that right? Yeah, you need 2884 a week. And then if you divide that by the 800 shares, or the 8 covered calls, so you'd need to make 360 a week. And I generally multiply that times 4. So you'd have to sell this strike, or excuse me, the strike that paid that much premium in order to work out to 150. And that puts you right about here between the 415 and the 420 strike. Um, and if we're in a bull market, there's like, yeah, since the delta's on here is 34, you're going to be able to get away with this 2 out of 3 times. So 2 out of 3 times, your strike would get breached and you would have the potential to have shares called away. And even if you can roll out and up and not have shares called away, you're not rolling for a credit. So that's eating into your profits. So I think it would be easy enough to capture 150,000 a year, but the second part of that statement the qualifier of without losing shares, I think, makes it unlikely. So you can easily select the strike that will get you paid the amount of money that you're asking for, but this strike is pretty aggressive. It's only 10% out of the money. And with this delta, you're going to be rolling. You're going to be rolling every, every third attempt. You're going to be getting wrecked on this strike. So like 4 out of 12 months when you take this position, you've got the potential to have shares called away. Yeah. I think that explains it. All right, we're all caught up on chats. So I hope this was helpful at all and gave a little bit of glimpse of what MSTY is up to. And I think it's just easy enough to do this ourselves. There's no magic strikes, right? They don't there's no strikes and expiration dates that MSTY has access to that we don't. The only argument that I've heard that makes the most sense is like if you've just got 100 shares and you fuck that up, now they're called away and you can't sell covered calls anymore. And with Misty, like they've got a near infinite supply of money. And if they get 50,000 shares called away, you know, they've got $1 billion assets under management or whatever. But I, yeah, I'm just not excited about their their trade selection. I'm I'm not impressed really. Like there's no I don't know what I'm paying for. Like what's the 1% management fee getting me? I don't really see a benefit to it. So not financial advice, but that's just my personal opinion. I can are the 10 deltas in the above example really that safe though? Yeah, that's a good point. So if it's a 10 delta, statistically, you should be getting wrecked once out of every 10 goes. Um, but that 500 strike, like does even the 1 out of 10 times, does it go to 505? That'd be really easy to roll for a credit. But if this goes to, 550 or 600, trying to roll for a credit could get dicey. So, um, yeah, for me personally, there's no safe strike. It's just safer. Like on the risk curve, I suppose, the 10 deltas are much safer, but no strike, especially if Bitcoin like if Bitcoin runs to 150 to 200 suddenly, there isn't a safe strike on the entire options chain. If that happens, the 1080s aren't safe. And I wouldn't waste my time selling a 1080 to collect $25. I'd just rather have the 1080 money in that case. But everything's a trade-off. Thomas Sowell, there are no solutions, only trade-offs. But great point. All right, we're all caught up on the chats. Appreciate everybody tuning in.